Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton. I'm your voice in the mortgage industry. 888-713-2929, our telephone number here at the studio. You can give us a call right now and get online and in line in order to have us answer questions about what you're going to do now. It's springtime 2019. There are a lot of statistics out there right now that may or may not interest you. One that you're probably very aware of is that interest rates, albeit last month, were smoking. This month are about a quarter point higher. That is not pleasant news to anyone, but they're still a quarter point lower than they were this time last year. So although we have mortgage applications down this month about 6-7%, they're still 6-7% above last year. So we're in a netherworld of not quite knowing where rates are headed, although I do believe that we will see gradual increases, as we always do when the summer months roll around. I don't think we're going to see Fed rate hikes this year again, although we have heard some of the people who are over at the Fed Open Market Committee meeting again. Let's see, what month is it? No, next month. Anyway, there are a couple of them talking about lowering rates by a quarter point. I don't think that's going to happen either. The economy's fickle, right? Anybody out there who probably is working is thinking, what do you mean it's fickle? I'm working, I'm making money, things are pretty good, my neighbors are working, they're making money. Houses, although they haven't gone up again this year, are going up 3-4% probably this year. So my house is worth more than it was worth when I paid for it 2-3 years ago, so things are looking up. The fickle part of the economy has to do with what's happening in the outside of the United States in the economy, also in the manufacturing sector, also in a lot of foreign players who, this problem we've had with China with the trade war that's been going on and on and on. We seem to have lost focus on it, but it still affects how we are spending our money here in the States. If, in fact, we have products that are having tariffs slapped on them from China and being sold to the United States at a higher price, well, that affects how you purchase and the things that you can purchase. And when you're looking at purchasing something, whether it's a refrigerator or tires or cleaning products or clothes or any number of other items that may not be made here in the U.S., you're going to have some issues because prices are going up. Now, why does that matter? Because the more money you spend on other things, taxable items, tariff items from China, the less money you can afford to spend on your monthly mortgage. Now, I know your debt-to-income ratios and the calculations that they'd make about your ability to repay, and that's a big number, right? Whatever it is monthly, $2,000, $3,000, $4,000 a month, could be even more depending on your loan. And in Southern California, San Bernardino and Riverside, I say hey to you out there once again each and every week, KCAA, KMET, and up in Tahoe, our K-Tahoe affiliate up there. I want to say hi to Central California and all of our great people who listen each and every week. Yes, the economy is in flux, is in a bit of a nervous state, although you might be doing well. That's the reiteration of the point I just made. Okay, a couple things quickly while we get to the show. If you're one of these people who goes on YouTube, this show each and every week is on YouTube. Now, Daryl, I want to ask you a question. In terms of YouTube itself, how much time do you spend looking at things on YouTube?
Me personally, every time I go there looking for something in particular, I look at other things as well.
Okay, so you're a user. You're somebody who enjoys YouTube.
Maybe an hour a day.
Oh, okay, excellent. Okay, so we're of an age group, Daryl and I, which may be considered too old for social media or multimedia, especially YouTube or Instagram, Facebook, and LinkedIn, and any number of other different social medias. However, I think YouTube is one of those things that kind of goes across a lot of different, genres and people and age groups. Don't you think?
It's not genre specific. It's not age group specific. I don't think. My wife goes on there she'll find out how to fix anything on YouTube.
Right. That's what I like about it, too, is that if you have a question, there's a video on it. And I don't care what the question is. Believe me, there's a video on it.
And I challenge her. I say, you're not going to find that. And it's there.
No, 7 of them. 3 different people, 2 different languages. Here you go. Here's the answer for you. So the reason I bring it up is because this show is on YouTube as well. And we appeal to a lot of different people who look at what we do on the show. So we've recently reformatted a couple of the shows and done some things differently. And we had posted our Las Vegas real estate show up last week. Anybody who's thinking about maybe moving out to Las Vegas or want to know a little bit more about what's going on in the Las Vegas market, either mortgage or real estate, check it out. It was on last week. I think it was the 16th. Yes.
It was last week's show, so it posted a couple of days afterward. I believe it's dated the 12th.
Okay, very good. So it's important to understand each market is a little bit different, and getting to know what happens out in a different market really takes a bit of research. This show, if you're listening to it now, you like the format, you like how we interview people. Well, we did that last week from Vegas, and we try to do it with all of our affiliates around the country, whether it's down in Georgia, in Illinois, Virginia, certainly in Nevada, Washington, a number of other states, Texas, Arizona, where we have loan officers and people who work with us. We like to bring a perspective to the show that you can see, okay, maybe Southern California, maybe my house out here in Rancho was a little too expensive each and every month, although I've got some equity into it. Maybe I want to move. Well, this is a way by which you can do it, and certainly archived on YouTube. The YouTube channel, by the way, is, if you go to YouTube, just look up my name, Jeff Barton, the real estate voice, or just Jeff Barton, and you will see that there are hundreds of videos, and each one of them can give you some information, and a lot of them have guests from other states, certainly Nevada being one of them.
Yeah, you were right. It's the 16th.
Okay, excellent. So if you want to look at the show from last week, the Las Vegas real estate show that we did, talking about Las Vegas real estate mortgage prices from the people who live and work there. Interesting place. I like it a lot. We visit out there. We do the show live from there as well. And we will be soon doing a reverse mortgage show out in the Las Vegas market. We're going to try to bring a couple of 3 guests, but certainly one of our experts, Nina Penny, on the show to talk about the reverse mortgage product, what it is, how it works, how it might differ from what you think it is, and then what are some of the advantages that you can take advantage of. I mean, people in my age group, 62 and above, definitely can take advantage of it. You can purchase, you can take money out, you can stop making payments. There's a lot of advantages to it, but there are some requirements. And so we're going to spend a couple, 3 weeks on that particular show talking about reverse mortgages. And in the Nevada market, in the Los Angeles, San Bernardino, Riverside, Orange County, and certainly up in Ventura, there are a lot of people who are elderly who can take advantage of that particular product. I want to talk a little bit now about what's happening to our old friend WMC Mortgage. Now, back in 2007 and before, there were a lot of subprime lenders. Now, we have got a definition of what a subprime is versus what a non-QM is. A non-QM loan, which is what happens today, tackles a lot of the same type of borrowers. The programs that are available are not 100% similar, but they have the same feel and the same usage as a subprime mortgage did. The difference being, of course, today in the non-QM, non-qualified mortgage space, the government entities, GSEs, do not purchase these, whether it's Fannie or Freddie or Ginnie Mae. They don't purchase any of these type of loans. So most of the loans, or all of the loans that are done, which are non-QM today, are in portfolios of the companies that do the loans, or are sold to hedge funds, Wall Street, insurance companies, sovereign funds. They are not held by Ginnie and Freddie and Fannie, and that's about 30% of the loans in the United States. Saw some interesting charts exactly what that is and how that affects us as consumers. But WMC Mortgage was bought by GE Capital, had to come up with a $1.5 billion fine by the federal government through the Department of Justice for the subprime mortgages back in 2007 that were bad and that were misrepresented as to their value. Now you think about that. 2007, it's 2019. 12 years later, this is still going on. I bring it up because it's a fact of life that we still have to consider on each and every deal, and why the regulators are so much on us as lenders to make sure each loan is quality. I'm Jeff Barton. I'm your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's our telephone number. Pick up the phone, give us a call. We talk about mortgages. We talk about all things real estate. We talk about anything and everything you're going to need to know when you figure out if you want to buy that house this year. Maybe you want to sell. I don't know. There's all kinds of opportunities in the market, in any market. I don't care what people tell you. If they say, oh, the rates are too high, or, oh, the prices are too high. Well, you know what? California has one of the roller coaster type real estate markets, and that would be most definitely in San Bernardino and Riverside, our listening audience, and certainly up in Tahoe, and probably down in San Diego, where our first guest on the show today is going to talk to us about what's going on commercially, because I know that's of interest to a lot of people, and we don't get a lot of information about what goes on in San Diego on the show, and I'm really happy to have him because he can be our guy in the sky down there. Tyler Sinks from Berkadia. Tyler, how are you?
Doing well, Jeff. Thanks.
Hey, excellent. Okay. Give us a little bit of a synopsis of what's happening currently in the market down there. I know the last time we spoke, which I think was about a year ago about it, we were getting into a lot of building, and there were a lot of, multi-unit stuff moving. What's happening now?
Yeah, so I would say that the trend has definitely continued down here. We're seeing a lot of new development, primarily on the multifamily side. There are some high-end luxury condos going up as well, primarily downtown San Diego.
Right.
But across the spectrum, I'd say if you look across San Diego County, which is also true in places like Orange County and Los Angeles as well, a lot of the new development is happening kind of in the urban core. We're seeing a lot of very high-end luxury apartments. And kind of the thesis behind that is a lot of millennials are going to be renters long before they can ever afford to buy a home, which is something I'm sure we've all heard of.
Right.
But that's especially true in places like Southern California, where it is so expensive to own a home. So a lot of these developers are getting into the multifamily space in a very big way. In the last 5 or 6 years, we've seen the cap rates on apartments, which is effectively sort of the multiple and return that you would expect when you go in to buy a property, at all-time lows, which it has an inverse relationship between price. So those cap rates have been kind of in the low fours. It basically has trailed where interest rates have gone, and since interest rates have been historically low, we've seen very attractive financing available, right, which has ultimately pushed the prices of multifamily properties to near record highs.
Now, okay, that's interesting and a lot packed in there. Let's deal with, first of all, high density downtown. San Diego, it never was like that, but you're seeing it obviously more and more.
Yep. Yeah, so downtown San Diego, up until about 15 years ago, before they opened Petco Park down in the Gaslamp District,
right,
was primarily a pretty sleepy market. Well, nowadays, the thesis is that folks don't really want to get on the freeways. People don't want to sit in traffic for 45 minutes or an hour. So why don't we build more housing next to where the jobs are? Well, if you look downtown, there's over 11 million square feet of office space in San Diego County, just in the downtown district.
Wow.
So basically, there was a lot of pent-up demand for housing closer to jobs and office space. Well, now we're finally seeing that need kind of filled by a lot of these big merchant builders, the Alliance Residentials, the All-In Partners, the Gray Stars, the Equity Residentials, etc., really filling the gap and starting to build, hundreds and hundreds, if not thousands of units in our downtown core. On the suburban side, on the outskirts of kind of the core downtown urban markets, we're seeing a little bit less development, primarily just because there's the lack of developable land.
Right.
But at the same time, there is a lot of multifamily development happening in Southern California relative to the last 10 or 15 years.
And you're thinking most of this is rental, or is it a generous mix of rental and owner-occupied?
It's primarily rental. I
Uh-huh.
would say probably 75 to 80%.
Okay.
And a lot of that has to go with the financing. There's a lot more construction financing available for multifamily for rent product relative to high-rise luxury condos.
And the reason for that is what? Litigation? I mean, because you have one real owner and basically they are controlling the property, so if there's ever a problem, that's where you go. But if there's multifamily and people sue the builder, is that why the financing is so high?
A little bit. That's partially kind of the reason, but I think the other part of it is it's a lot easier to lease up a unit for,
Right.
let's say, $2,500 a month rather than sell a luxury condo for over $1 million.
Okay, price.
So the idea is we can get rid of a lot of the products, fill it up, start, reaping off the cash flow
Right.
a lot quicker by going for rent versus for sale.
I see. So, again, you mentioned the $2,500 figure. Is that typical of the rents you're getting down there?
That's about average across San Diego County. That might be on a little bit of the higher end of the spectrum, but again, this is primarily newer product in the downtown core location.
Sure. That to me seems pretty reasonable. I mean, I'm living up in Los Angeles County for a number of years. Rents here have always been high, right? I mean, that's what we're looking at because of the demand, and yeah, it seems reasonable. Obviously, you talked about the millennials. What about other people affording that? And are we seeing a growth in the population of the people that can afford that kind of rent? Obviously, there must be.
Well, I think that's kind of an interesting point because for the last couple of years, the luxury apartment buildings have not had much of a problem leasing up. As of late, we're starting to see a lot of large apartment owners giving concessions as much as 2 or 3 months free on a 13-month lease, which is a sign to us that maybe the market might not be quite as deep as a lot of folks were really hoping. And really, at some point, you kind of reach a ceiling where there's only so many people, so many prospective tenants that can afford these high rent points. So at some point, I do think that the supply, and we might actually be getting close to that point now, where the
Right.
supply is finally starting to catch up with demand. Obviously, during the recession, 08, 09, and 2010, there was no new development, so there was a bit of a lack of supply during those years. So I think we've had the last 5 or 6 years to really catch up, and now I think we're finally starting to see some more balance come back to the marketplace. Rents are starting to flatten off a little bit. We're not seeing the 6 to 10% year-over-year rent
Right.
growth that we had been seeing. And obviously, concessions is another sign that landlords are eagerly trying to lease up their buildings.
Right, absolutely. Opportunity in the market for somebody who's looking to invest in San Diego?
There's always opportunity, like you alluded to. I think a lot on the value add, quote unquote value add space, which is primarily buying an older building, maybe a 1960s, 1970s apartment building, and spending some money on it, fixing it up, and at the same time maybe pushing the rents a little bit. So we're definitely still seeing some opportunities in that space.
Okay.
I think really the financing, as long as the interest rates remain near historic lows where they are today,
Right.
that's really fueling the market. And then really on the larger commercial side, kind of the Fannie and Freddie
Right.
agency loans, we're seeing a lot of full-term interest only, which has really been the biggest catalyst in our business and really helping to make a lot of these pretty thin deals pencil, is the interest-only periods that a lot of these lenders are putting in the loan terms.
And okay, so you say that. Does that mean the term would be like a 3 to 4 year loan or a 2 to 3 year loan where you're only paying interest rates with a balloon at the end?
Yes, but typically, and actually on the multifamily side, it's usually 7 to 10 years.
Oh, okay. I didn't know because I don't do a lot of that kind of lending. So, and there are obviously lenders out there who love that kind of loan.
Exactly. Yeah, there's a lot of life insurance companies that will
Right.
do it. We're seeing a lot of the Fannie and Freddie loans that are obviously government-sponsored,
Right.
that are pretty aggressive in that space. So that's really what's keeping the market going down here. And obviously when you have full-term IO options out there,
Right.
it really helps to keep the pricing inflated and make a lot of these deals pencil.
Oh, that's excellent. Okay, so if someone wanted to get a hold of you about some opportunities and maybe get a better education than this quick radio interview about what's going on in commercial down in San Diego, how would they get a hold of you?
Yeah, so the best way to reach me is probably either by phone here in the office, which is 858-257-4706, or you can send me an email at Tyler, Tyler, jeff.sinks, S-I-N-K-S, at Berkadia.com. That's BERKADIA.com.
Okay, excellent. One last question. Tyler is related to me. Everybody out in the audience, a bit of a disclosure there. And we do races together, and he's about ready to go off on doing another one. Do you think that San Diego lifestyle, because of the fact that not only did you grow up there, but you have, all the advantages that you take care of, gives you any kind of a leg up in the business itself? I mean, San Diego's your hometown, and you love the lifestyle and everything about it.
Absolutely. I think growing up here and really seeing the city change has really kind of added to my knowledge of where it's been and where it's going. And obviously, knowing just my way around town and different little pockets and gentrifying areas that I've kind of witnessed firsthand has definitely added to sort of my intimate knowledge and sort of a competitive advantage, you could say, that I have in the San Diego marketplace. Well,
you're really knowledgeable, and I really appreciate it. I mean, you were spitting out facts one after another. Thanks for coming on the show, Tyler. I really appreciate it.
Hey, thanks a lot, Jeff.
And thank you very much. That's Tyler Sink from Berkadia. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929, telephone number here at the studio, where you can pick up the phone, give us a call, talk to us about what your questions are about the mortgage that you currently have. Maybe you're into something which you're not quite sure what it is. There are a lot of hybrid products out there that are coming due, i.e. if you had an interest-only loan, if you had a variable interest rate loan dating back, even 10 years ago when the mortgage crisis happened, a lot of these loans are now coming due. So you're kind of freaking out because they're asking either for a balloon payment or they want you to adjust to a higher rate mortgage. So that's a problem that you probably got to deal with ASAP. If you still own your home and you've been making those payments, you probably have terrific equity in it. Maybe you want to take some money out and lower your interest rate. On a deal like that, we can probably make that happen. Give us a call over here at Malibu Funding, the great company that I work for that sponsors this show, and that's 888-713-2929. If you want to pick up the phone and give us a call, be happy to help you, happy to be able to answer any and all questions. Big Tex, Wealth Wave, man who has been on the show many times, talking to us about not only retirement and being able to save for the future, but also about your credit issues, being able to educate people. He's got some terrific videos on Facebook that I'll let him explain to you. But bringing him on the show right now, Terrell Robinson. Big Tex, how are you?
Hey, how you doing, Jeff? How's everything going?
You know what? Could be wetter. It could be better. I was going to say it could be worse, but I came out wetter. So anyway, it's fine, and I'm glad you're on the air. Tell us a little bit about what's happening in your life. You were telling me about a seminar you did last night out in Las Vegas for some of the community members at a church. So tell me about some of the education you're giving people about how to prepare for their retirement and their future.
Absolutely. Well, the first thing we sat down last night and we wanted to speak to the community about was first thing was the credit. And the reason being I mentioned credit before we even get into the financial situation is if you're someone that doesn't come from the Rockefellers, if you don't have the Kennedy-type money, then you have to have some type of credit to be able to leverage that to be able to purchase a home.
Right.
And that's going to save you if you have a certain credit score. Now it will put you in a position to where you don't have to put down 5% or 20%. You may have to come in with 3.5%.
Right.
So we wanted to educate them on credit and things that as little as paying down your debt ratio. It could be as simple as you have one credit card that's $1,000 limit, and you've charged up $500 on it. Now, we know that 50% is not bad, so you're figuring that, hey, I'm doing okay. It's manageable, but it's also hurting your score.
Right.
So what you want to do is pay $200 down, and that's going to drive your score up another 15 to 20 points. That can be the difference of having a 625 and having a 640, extending that lease for another year, or now you're walking into your own home.
Well, that's the
Also,
other thing too, right? I mean, in as much as that's the difference between getting a home, but it's also the difference in tens and thousands of dollars based on the rate you're going to get.
absolutely, absolutely. That comes into a big play too as well, Jeff. And another thing too, when it comes to credit and also your home buyers out there, look at the inquiries. I know sometimes during the holiday season
Right.
we get a little happy and we want to get an inquiry for this card or for this promotion or for this promotion, and we decided, you know what, I really don't want to take that card on because that's more responsibility. Well, legally and technically, you can have those inquiries removed. Now, that'll move your credit score back up. Just
Okay.
had one yesterday.
Explain that a little bit.
Came back, he removed 3 inquiries, score went up 15 points.
But tell me about, okay, so everybody has been in a situation where whether you're on a plane or whether you're at a store or whether you're in a mall where somebody's standing there shoving a credit card at you and you decide, okay, I'll go for it, but later you change your mind. You're saying that you can get that particular inquiry that credit card company is going to have on you removed from your credit score or your credit report?
Absolutely. If you were turned down or you denied, you decide you just don't want to have whatever it is
Right.
that they're offering. Like, for example, the biggest thing that most people miss is when they go apply for a vehicle. Their credit is pulled at least a minimum 3 times.
Right,
Well, you're not going to get your loan to 3 banks.
right.
So 2 of those inquiries, have them removed. That could be the difference of 5 to 10 points right there, 16 points actually in
Hey,
a car dealership.
And,
So
and
that's
do you
very
help people do that, Big Tex?
yes,
Okay.
absolutely.
All right. Shout out your phone number. Anybody out there who's listening right now who looks at their credit score, looks at their credit report and sees inquiry, or credit score affected because of inquiry, you're going to need to be able to know how to take these inquiries off your credit report. Call Tex right now. Shout out your phone number.
Area code 702-882-2103. And again, that number is area code 702-882-2103.
Okay, that is just practical, useful, and immediate information that people can act on right now. I appreciate you doing that.
Absolutely. Thank you very much, Jeff.
No problem at all. Okay, so we dealt with some of the credit issues. Give us some of the other fascinating things that you tell people about what's going to happen and how to prepare for when they get old, like me.
Well, the biggest thing is long-term care. If you're already sitting down with an advisor and you have your retirement in place or your private pension fund in place, make sure that you have some type of long-term care that's set aside, because if anything were to happen, you have to go into the home. You're looking at least $8,000 to $12,000 a month.
Right.
Long-term care is very expensive. Everyone believes that they're going to live to 90 years old
Yep,
and be
and then go to
extremely
sleep.
healthy,
Right.
and that's just not the case.
Right. No, I agree with that. So what is your suggestion for these people when they do that? Do you have a plan yourself?
Here's a small thing that they can do. If they're sitting down, let's say they have their own person they're sitting down with, one of the things that they can do is they can have their advisor add a rider onto their policy. And that rider will allow them to build up some long-term care. So any event that if something happens, now they're not scrambling and trying to take a church fund out or do a car wash. Now you have that situation taken care of. One of the things that I do is any client that sit down with me, we get them set up. The companies that I go through, since I'm non-captive, I represent multiple companies.
Right.
The companies allow me to have that on their policy. So if a client is sick, becomes ill, they cannot perform 2 out of their 6 daily functions, now we activate 2% of that policy. So if it's a $500,000 policy, that's $10,000 a month. That can cover a lot of bills.
Oh yeah, it can. And is this affordable? How does one get involved with it? Obviously, you shouted out your phone number, but give us some ideas how it works.
Well, there's a couple of things. Yes, it's very affordable. If you cannot afford a permanent life insurance policy, for one, you can get a term life insurance with living benefit rider or long-term care attached to it.
Right.
Index universal life as well, which is extremely important. You want to be able to take a look at adding long-term care, the living benefit rider, because you just never know when you may get. It could be a car accident. We don't know what could happen, but these things come up, and a lot of us people, we're not prepared for it. See, Jeff, we're planning our vacation. Like when my wife and we just got back for our 10-year anniversary in Mexico.
Congratulations.
Thank you.
You're welcome.
We planned this thing down to the T. It took a couple of weeks. And then when I got to thinking about it, I said, wow, a lot of our clients don't even plan their financial lives.
Right.
But they'll plan their vacation down to the letter.
Yeah.
So we have to get into a system to where we're planning our financial lives, because, we're leaving children and grandchildren behind. And here's another thing, too. Pensions are going away.
Yep.
So now, how are you going to outlive your money? Because I haven't came across a person yet who has $1 million put away in their 401k.
Right.
So how are you going to make this money last when you retire 20 years from now, after you're retired? That's where you got to look at the private pension fund, something that's going to allow you to receive a paycheck every month for the rest of your life, or to the age of 120 years old. Just deliver the policy today to a client. Now he does not have to worry about running out of money.
Hey, Tex, I got to go. I'm sorry. We could absolutely do this for another couple hours, because it's fascinating when you're helping people. It just kind of flows, and I appreciate you coming on the show and doing it once again.
Thank you very much, Jeff.
Thank you very much. And that's Terrell Robinson, Big Tex from Wealth Wave. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. Telephone number, pick up the phone. Or you know what? Write down the phone number. I say this each and every week. Write it down. Wait until you hear something that you like, or you have a question about, or you just don't like. Then give us a call at that point. Leave a message. I'll call you right back. Reason is that sometimes listening to the show, you get caught up in, what am I supposed to do? Should I pick up the phone? What should I do now? Just save the number. Call us when you have a question. Call us when you have a problem, a question, an answer, anything you want to talk about when it comes to mortgages, the rates, whether they're going to go up and down, what's happening with real estate prices. There are so many questions especially if you're out there right now thinking, I want to buy, but I don't know how to do it. Or I want to sell, Yeah, all these things are important, but the main thing is listen to the show, think about what we're doing, see if you have any questions about what we're talking about, and then you can definitely give us a call. Email info@malibufunding.net. Also, we can be reached via Twitter at Jeff6493, my Twitter handle. And of course, I'm on Instagram and Facebook and LinkedIn. All of these, you can reach us, reach me, and we can help you in your mortgage decisions or your real estate questions that you probably have. We are at KCAA, KMET, and K-Tahoe. We are in San Bernardino, Riverside, a little bit of LA, a little bit of Orange County, and certainly Inyo. And up in the Tahoe area, I want to say hi to those great folks up there who have begun to really respond to what we're doing on the show. Thanks again for listening. With us again today, great guy from Lone Stream who has been on the show many times, but also has the best information about programs that can help you with getting your next loan. And I'm, of course, talking about Tomas Trujillo. Tomas, how are you?
Hey, Jeff, I'm doing great, buddy. How are you today?
I'm great, thank you. Sorry about the long-windedness of my intro. I wanted to get you on quicker, but I just couldn't stop talking.
No worries. I got the same problem.
Excellent. Okay. Tell us about what's happening in the market. We saw rates go up again this week after being had gone down quite a bit in March. Now they're back up. In April, the last 2 or 3 weeks, they were about 4.5% again. What's happening with rates, and what kind of products do you think are rate insensitive, meaning that it doesn't really matter?
You know, it really doesn't matter anymore. I mean, you have some people who are very into the rate, and I want the best rate, and who will kind of try and bang you over the head.
Right.
But usually, those guys can walk into their bank and get the best rate out there.
Right.
And that's fine. I'm not too interested in those guys anymore, because I want to help the guy who needs the help, who's like you know what, I want to buy this property. It's an investment property. It's a great deal, but I don't show my income. What do I do? I report everything on a 2106 on my taxes. I show maybe $3,000 a year.
Right.
But I make all this money. We got programs for that now. We're doing DSCR programs.
What's that?
No ratio programs. DSCR is where you let the property qualify for you.
I see.
So we are not asking you for a dime. We're not asking you for any taxes, for pay stubs. We're asking you for no bank statements, nothing. All I want to know is that will the property take care of itself if it has to?
Meaning that it would rent out? Is that what you're saying? Meaning it would rent out? Is this a non-owner-occupied loan? What is this?
Non-owner-occupied property. It's an investment, single-family units, doesn't matter. If the property, if the rent on the property can cover the payment, you got a loan.
Excellent. What's the down payment on something like that?
On something like that, it's about 20%.
Okay.
5% from you. The rest can be gift.
Okay.
Amazing program. Now, let's say you got a property where the rate is high and maybe you can't cover it, so the rent is low. So we would go no ratio. So I'm not asking for anything. If the property is standing, we'll do a loan. It's kind of like in the old days in Guardian Savings where we would do a mirrored loan.
Right.
If you hold the mirror under your nose and it fog, you got a loan.
It's funny, although I remember those days too, back in 2007, really wasn't quite great at that time because the whole market crashed. But these are different kind of loans that aren't sold to Freddie Mac and Fannie Mae, right? These are portfolio type products or private money products, right?
These are our portfolio products. We have investments on them. We have our hedge fund who will insure them for us, so we are good to go with them. We're doing these loans. We're doing VOE only loans. We're doing 1099 only loans.
Right.
We're doing we got a slew of loans now. We're doing I-10 loans. We're still doing down payment assistance loans as well.
Now you mentioned the I-10 number loans. These are for people who aren't citizens per se, but who own businesses here, or these people that just own businesses and don't want to use their Social Security numbers?
Neither. They're for people who came over and they haven't processed through the system yet.
Okay.
But they're still in the system, and the IRS gave them an I-10 number so they can write off their taxes, so they can do their taxes. I
see. So these are persons. These are not corporations per se.
These are persons. These are not corporations. So if your aunt came over and she's going through the process, but she doesn't have her permanent resident card yet, but she does have an I-10 letter from the IRS, she can get a loan now.
Hey,
you can go as high as 85% on these.
Tell me something. Where taxes were just filed for everybody, right? April 15th, unless you got an extension. Are you seeing slowdowns at the IRS in terms of 4506s or in terms of what you just said about the I-10 product letter from them in terms of identifying for, obviously, the lender who's going to lend on the property? Do you see any slowdown there at the IRS, or do you think everything's okay over there?
I haven't seen anything yet, but typically right around now they'll start to slow down. They'll start to slow down a lot, and we won't get our transcripts for, they usually come out 2 or 3 days. It'll probably take 3 or 4 weeks. So that's pretty typical around this time.
Okay, and you don't see that as an issue in terms of getting loans done, especially in a purchase contract?
Oh, no. I mean, we always have ways around that. We'll ask you, hey, did you file electronically? If you did, great. Go ahead and give me that receipt. Or if you sent them in to the snail mail, that's fine too. Let's go to the IRS and get them to verify a copy, and we're good to go.
Okay, very good. Any other problems out there that you see in the marketplace in terms of maybe the economy or other things that could affect somebody's ability to get a loan this year?
I think things are getting better. I think there's been a lot of turmoil. There's been a lot of talk. I try and stay away from all that because I really don't care, because here in California, especially in California, this is the best place to live. It's the best place to buy. So if you're going to do it, here's where you're going to do it. So there's always opportunity. I mean, rates go up and down.
Yep.
They're not. When you and I got into business, rates were 19% at par at C of A.
Yep, that's right. And people were doing them, by the way.
Absolutely, day and night. So these rates that we're seeing right now, they're still great. There's nothing wrong with them. Loans are easier to get. everybody is starting to realize, hey, we have to keep the economy going. So let's get investors out there. Go out and buy an investment property.
We
That's
talk
what it's all about.
Yeah, okay. We talk a lot on the show about millennials, right, and whether they're going to rent or buy. I think a lot of millennials are afraid of putting down a good deal of money or don't have the money. Are you seeing that the buyer in the purchase market is younger, older? What are you seeing in terms of the loans that are coming in the door there?
We haven't seen too many young people.
Right.
The average age is, I just got married, or they're having the first kid. Average is about 30, mid-30s, early to mid-30s.
Right.
But, I mean, there are programs out there. If you don't have the money for a down payment, but you want this house, you can go through a down payment assistance, Cal half a loan. You can get that house. If you can't afford the house, get the condo, get the townhome. You can do it. I mean, I think they're a little afraid because they saw what happened a couple of years ago to their parents.
Right.
But those parents came out of trickle down theory, where let's buy, here's spend. These consumers are a little more savvy. They're holding on to this money a little more.
Yeah, and overall in the economy about jobs, it looks like anybody who wants a job can get one, and that can only help in terms of trying to get a loan. Obviously, you need a job in order to prove that you can pay the loan back. I just think the economy overall, jobs-wise, is doing gangbusters.
I think it's doing great. I mean, I think McDonald's announced today that they were going to hire 2.1 trillion. They're going to have 2.1 trillion job openings this summer.
2 trillion? No, it can't be 2 trillion. Maybe 2 million across the country. 2 trillion.
I have bad hearing, so you might be right.
Yeah. No, exactly.
It
2 trillion. Well, that's more than the population of the earth.
Well, it was so much that they're going to start pulling seniors in instead of kids.
I see. Tomas, thank you very much for coming on the show once again. Great description of the programs that can help people. I appreciate that.
Jeff, always a pleasure. Thank you very much.
And thank you, too. That's Thomas Trujillo from Lone Stream. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton. I'm your voice for the mortgage industry. 888-713-2929. That's our telephone number. If you pick up the phone, if you give us a call, we talk about mortgages, we talk about real estate, anything involved in those two very specific and very demanding things that are going to go on in your life if you're thinking about buying and selling a house this year. There are millions of people moving in the springtime to the summertime before next fall when kids go to school. So we always call this the spring buying season. And, of course, people are buying all year round. And anybody who's looking has probably been looking for quite some time, looking for a deal, looking for something that they can, get into cheap, get the right rate on your loan so that you can afford it. Okay, so Fannie and Freddie, let's talk about this for a moment. Everybody knows that most loans done in America, especially the conventional ones and the FHA ones, are all purchased by the government-sponsored entities, GSEs, Fannie Mae and Freddie Mac. Now, during the mortgage crisis in 2007, when both of those, they were private at the time, got into trouble, right? And they were, let's say $200 billion in the hole. I think it was more like 168, but let's call it $200 billion. The government came in, bailed them out, but as a result of that, they took ownership in stock, non-preferred and non-voting stock, but they took ownership, and I think it's 75%, 80%. It's a big number, right? So each and every quarter, the Treasury Department takes the profits of Fannie Mae and Freddie Mac and sweeps them into the Treasury. And they've been doing that ever since Fannie Mae and Freddie Mac became profitable. And I would say that's probably been going on, let's conservatively say 2011, 2012, right? And the quality of the mortgages went up and the profitability went up and the dangers to Freddie Mac and Fannie Mae and Ginnie Mae went down. Ginnie Mae's answer to it on the FHA side was to charge more money in the upfront funding fee as well as the monthly fee. So if you've got an FHA loan right now, you're probably paying an extra $200-300 a month just because you have an FHA loan and you're paying that insurance. You're paying the finance charge on the insurance and the mortgage insurance each and every month, each and every payment. So the reason I bring this up is because there's always been talk, right? And I know you're probably sick of hearing it, but Fannie Mae and Freddie Mac, there are discussions to try to turn them private again. And part of this has to do with the fact that the money that they make, and they've been making very good money the last, as I said, 5 or 6 years, probably a little bit more, they do not get to keep that money. There is no reserve for Fannie Mae and Freddie Mac, by the way. If something happens to the economy, let's say we have a 10% downturn, and we have 10% of the loans currently on the books or being originated today go bad, or just, they can't pay, and they go belly up and bankrupt. Well, just to give you an idea, during the height of the mortgage crisis back in 2007, 30% of the loans went bad. So we're talking about a much milder type of occurrence, but still 10% of the loans is a big number. But let's say that happened. Freddie Mac and Fannie Mae would again have to resort to government coming in and bailing them out because they don't have any reserves because the government owns them and they keep taking all the profits. Now, why does that make a difference? Because in trying to privatize the money that is lent out back to the lenders in forms of the liquidity that they need in order to lend the money out, these companies need to keep turning loans over. But in order to do that, in bad times, they need a reserve. But they don't have a reserve because the Treasury keeps sweeping the money into the Treasury. And I'm talking, if you're looking at Fannie Mae and Freddie Mac combined, it could be anywhere from $7 to $10 billion every quarter. That's a big number. $40 billion for each one? That's a lot. And if you consider that $168 billion was given to them in 2007, well, a quarter of that is what? $40 billion. So if we have a downturn in the economy and we needed a reserve from Fannie and Freddie without government bailout, that's the problem. So we need to get these large behemoth type, structures, GSEs they call them, government-sponsored entities, back into private hands. I think that would be better for the market. It would be more protection for you, the consumer, who have had to come up with these bailouts time and time again, whether it's Lincoln Savings in the 80s, whether it's the Drexel-Burnham disaster at the bond market in the 90s, or whether it's, what happened in 2007 with everybody. Talked in an earlier section of the show, earlier segment of the show about WMC Mortgage, which was a big subprime lender. New Century was a big subprime, Fremont, Argent. There were a lot of companies just like WMC. Well, they have just settled with the government, as I said earlier, $1.5 billion of fines leveled against, which the company that bought them, which was GE Capital. So if 12 years later, they are still trying to sort out that mortgage mess, isn't it better to try to get these companies back in private hands so the government doesn't have to get involved with it again? Now, I agree. Government backing of loans is an important segment of being able to have liquidity in the market. Obviously, if the government's not involved and you want a mortgage, you're going to be paying more than, I think, where is it? I just saw it. Okay, the 30-year fixed rate loan today, 4.46%. You would probably be paying a point to a point and a half higher on that loan if the GSEs didn't exist as they exist today. But is there not a hybrid solution for what we need in the mortgage market? Certainly guarantees to companies about offsetting the negativity of losses in the mortgage market, if in fact we have a downturn in the economy, is extremely important. But we have billions of dollars of required, backing, I would say probably $1.5 trillion this year, of mortgages which are made by the GSEs or purchased by the GSEs. They're not made by the GSEs. The GSEs just buy them. Like from a company like who sponsors this show, Malibu Funding. Malibu Funding funds its own loans, takes those loans, and then sells them. We don't sell directly to Fannie and Freddie, but the company we sell to sells directly to Fannie and Freddie. So the liquidity in the market is extremely important to keep interest rates down. But at what cost? And what is a fair interest rate on a 30-year fixed rate mortgage? Obviously, we need have people have affordable housing. That's extremely important. And there are some great programs out there right now for affordable housing. The CalHAFA and the DRAMA programs. Both of these programs are designed to be able to give down payment assistance to people who need down payment assistance. And again, there are a lot of them, especially with house prices being what they are. So in terms of trying to get more liquidity into the market, you need the GSEs. But in terms of who's on the hook for the bill if things go south, yeah, we the consumers are. There has to be, and this is why it's taken so darn long to figure this out, because without the government involvement, rates will be higher, there'll be less lending. With the government involvement, guess what? Something goes bad, we as consumers are on the hook, and that really is not a good thing. Couple things I have in the news to use section, which I thought was pretty interesting as well. Everybody who has a mobile home, anybody who has a cabin up in Big Bear, anybody who's got a house that they purchased a long, long time ago knows that at one time, and even today in certain markets, in certain instances, you could have bought a house for 50 grand, 60 grand, 20 grand, 30 grand. And mobile homes today in certain parks, yeah, you can still buy those. So what happens if you want to get a loan on a house that you only need a $50,000 loan on? You can't get one. Why is that? Because most lenders won't do those type of loans. Now, the common myth is that those type of loans are less secure than a more expensive loan. Does it make sense to anybody? It never made sense to me, but that's the reason why most companies don't do loans. There's a great article by Jan Swanson, once again, in Mortgage News Daily, that talked today about actually small dollar loan amounts actually don't have any more risk at default than large dollar volume loans, which means that a $50,000 loan will pay off just as sure as a $350,000 loan or a $700,000 loan. The default rates are almost identical. And so if you're out there and you're looking around for a loan, the one company I know that does mobile home loans is called 21st Century. Not the real estate company, but it's 21st Century Loans. They actually are the largest one in the U.S. The problem is they don't have brokers. You have to contact them directly. So if you have a mobile home and you need a loan, those are the people to call. Anyway, I just wanted to get to that. I'm Jeff Barton. I'm your voice in the mortgage industry, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.